Ladies and gentlemen, thank you for standing by, and welcome to the Halo Collective third quarter earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to view the online presentation, please log into the webcast. Katie Field, President of Halo Collective, you may begin your conference.
Thank you, Josh. Good afternoon. My name is Katie Field, and I am the President of Halo Collective and will be your conference moderator. At this time, I would like to welcome everyone to the Halo Collective Q3 2021 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a corporate presentation which you can view on the webcast, as Josh mentioned, and that we have also made available on Twitter, Discord, and our other social media channels. This presentation given by Kieran Sidhu will be followed by a question and answer session with Philip Vandenberg, myself, and Kieran. Your speakers on today's call will be Kieran Sidhu, co-founder and CEO of Halo Collective, and Philip Vandenberg, Chief Financial Officer of Halo Collective. Before we begin, I would like to remind listeners that certain statements made during this conference call presentation may constitute forward-looking information and forward-looking statements within the meaning of applicable securities laws. These statements involve known and unknown risks, uncertainties, and other factors which may cause the actual results, performance, or achievements of Halo Collective and its subsidiary entities, or the industry in which it operates, to be materially different from any future results, performance, or achievements expressed or implied by such forward-looking statements. When used in this conference call presentation, such statements use words such as may, will, expect, believe, plan, and other similar terminology, and include, among others, statements regarding expected operating results, future growth, anticipated capital expenditures, corporate strategy, and proposed acquisitions. These statements reflect management's current expectations regarding future events and operating performance and speak only as of the date hereof. Important factors that could cause Halo's actual results and financial condition to differ materially from those indicated in the forward-looking statements include, among others, changes in the consumer market for cannabis products, changes in the expected outcome of the proposed changes to Halo's operations, delays in obtaining required licenses or approvals necessary for the build-out of Oregon and California operations, the proposed spin-out with Halo Tech Inc., or the proposed reorganization with Aconda Corp., delays or unforeseen costs incurred in connection with construction, the ability of competitors to scale operations in Northern California, delays or unforeseen difficulties in connection with the cultivation and harvest of Halo's raw materials, change in general economic, business, and political conditions, including changes in the financial markets. These risk factors are discussed in detail under the heading Risk Factors in Halo's Annual Information Form dated March 31st, 2021, and Halo's additional disclosure documents filed on SEDAR. New risk factors may arise from time to time, and it is not possible for management to predict all of those risk factors or the extent to which any factor or combination thereof may cause actual results, performance, or achievements to be materially different from those contained in forward-looking statements. Given these risks and uncertainties, investors should not place undue reliance on forward-looking statements as a prediction of actual results. Although the forward-looking statements contained in this presentation are based upon what management believes to be reasonable assumptions, Halo cannot assure its investors that actual results will be consistent with these forward-looking statements. The company undertakes no obligation to update or revise any forward-looking statements, whether as a result of new information, future events, or otherwise, other than is required under securities legislation. I will now turn the call over to our Chief Financial Officer, Philip Vandenberg.
Okay, Katie, thank you. I'll briefly discuss the Q3 and 9-month results for 2021. Q3 revenues were $8.7 million, a 28% increase versus the quarter in 2020. The volumes actually increased dramatically with 620% to 9.2 million grams. And excluding acquisitions, growth was 9.3%. The reported gross profit in Q3 was 1.6 million, and adjusted for biological assets and inventory impairments of 570,000. The gross profit was 2.3 million. The reported gross margin was 18.8%, and the adjusted gross margin was 26.5%. I think we could say that Halo performed well in a difficult market. I mean, if we take Q2 and Q3, the market was down in Oregon 15%, and we went down 6%. We declined 6%. In California, the market declined 18%, and we actually advanced by 59%. So we did well in a difficult market, and I think it points that we gained market share. And in particular, our flower and pre-rolls business did very well. Sales in all categories did well, with the exception of edibles. It's a small portion of the total. Edibles did not increase. Everything else increased substantially. Turning to the operations, A&M. Q3 revenues declined with 6%, Q-on-Q minus 4.9% to 3.7 million. However, volumes increased with 93% to 1.7 million grams, and in particular, flower and pre-rolls did very well. Oils and edibles showed a small decline. The reported gross profit was 193,000, and then adjusted for impairments and for East Evans Creek's biological asset, the gross profit was 780,000, and the gross margin on that basis was 20.9%. And what we see is that gross margins are on an improving trend based on the fact that we are reducing our production overheads. Coastal Harvest has been out of action for some time, but that has been revamped. In Q3, our revenues were $704,000, and so for the 9 months, and Q-on-Q there was 126% increase in sales, really reflecting the fact that we have stepped it up again. Volumes increased 11%. Prices declined with 12%. The gross profit was 41,000. Gross margin was 5.8%. That's too low. The gross margin really should be at least 20%. So we're looking closely again at the production overheads to get those down, and operations and finance are working on this as we speak. In their mix, light resin did well, and distillate sales went down somewhat. Mendo was the kind of the captive buyer from Coastal Harvest. Revenues were 3.1 million, a 42% increase, and sales were 5.2 million grams. The gross profit was $629,000 with a gross margin of 20.4%. That is pretty much in line with what the gross margin should be, although again we are looking at reducing production overheads. Halo Winberry was acquired early in the year or late last year. Halo Winberry added $3.1 million to Q3 revenues, and it peaked in Q2 because Q1Q there was a 12% decline. We're actually doing well right now. Sales were 2 million grams. The gross profit was 1.1 million with a gross margin of 36%, and adjusted for impairments, the gross margin was 39%, and that's really where it should be. Operating expenses, they were 11.9 million. The major ones like G&A 2.8, salaries 3.7, professional 2.9, and marketing 1.3. And when you look at the breakdown, Akanda, which is Canmart and Buffalo, they added, or they explained 2.4 million of the operating expenses. In there is like 0.9 million for G&A, 0.9 million for salaries, and 0.6 million for professional fees. And then also acquisitions added 1.8 million to operating expenses. Kiran will go through this later, but we did an analysis and we looked at our operating expenses. They are too high, and we believe that we can reduce them by some 6.7 million on a quarterly basis. Reductions in G&A professional salaries are projected at 3.7 million. G&A is a 1.8 million reduction, Akamba 0.9, impairments 0.9, salaries 2.4 million reduction, which is Akamba 0.9, and overheads in Halo 1.5. Professional is 1.9 million reductions, of which Akamba is 0.6. There were finder's fees of 0.9 and closing fees. M&A legal is coming down as we don't do as much M&A anymore. That is a saving of 300,000, and we also saved about 50,000 in consultants there. Also, we looked at the production overheads at A&M and at East Evans Creek, and we see an immediate $600,000 production overhead reduction. Then, as Akamba at some point leaves, let's say, the consolidated numbers, $2.4 million of total expenses from Akamba will disappear. What we budget now for OPEX is basically G&A 1 million, salaries 1.3 million, and professional 1 million once we implement the reductions that I just discussed and will be discussed further. Then going to EBITDA. So EBITDA was a loss of 10.3 million, and adjusted for non-cash items of 4.5 million, the loss was 6 million. Turning to the operations, although A&M showed a negative EBITDA of about 700,000, adjusted for biological assets and impairment, A&M was just about break even. Winberry actually is quite profitable. Its EBITDA is 500,000. There was an impairment of 200,000, and its adjusted EBITDA is 700,000. So together, A&M and Winberry, they are organs, but together they are profitable. So Oregon is profitable. Coastal Harvest, EBITDA loss was 247,000. There was an impairment, and adjusted for that, the loss was 74,000 for the quarter. And in NDT, we actually made an EBITDA loss of 0.4. At the same time, we had an impairment of 0.6 million, and adjusted EBITDA was 0.2 million, which shows you that California is actually also profitable, be it slightly. And then corporate, and that's where we are really looking to cut. That was a loss of 5.5 million, and that really explains to a large extent the kind of the cash burn of 6 million. Cash flow. The net loss was 10 million. Impairments in quotes were 0.6 million. Non-cash items from the cash flow statement were 3.5 million, and that resulted in a cash burn for the 3 months of 6 million. Including financings, the cash inflow in Q3 was 2 million. There was 4.8 million in the 9 months. Then to get the cash burn down is, as I explained, Akamba explains 2.4 million. Once it is deconsolidated, there was a G&A impairment of 1 million, which really is accounts receivable. We impaired $973,000 there. Then we have overhead reductions of 2.8 million, which is in G&A, professional salaries, and we have production overhead reductions of 600,000. That would give you a positive balance if you add all that up to the cash burn of 6 million of about 800,000. Then you add the working capital increase of 3.5 million, and that's why you will still have a a negative burn. So therefore, the thing to look at is working capital. For example, and that's one of the questions, like our inventory increased with $4.5 million. If it hadn't, then we would not have a cash burn. The balance sheet. We have at the end of September we had $8.5 million in cash. Right now, including a financing that came in, we are at about $3.75 million. We have debt of $12.3 million. The net debt is 3.8, and we have a very solid balance sheet. Our net debt to equity is 3%. Our debt includes short-term $12.3 million, which includes a $9.5 million convertible that is due in April next year. Long-term $6.1 million, which includes a convertible of $1.2 million that we basically acquired when we did High Five. Then the capital structure. The company has shareholders' equity of $222 million at the end of September, and it had 28.7 million shares post-consolidation. And net assets after the accumulated losses, net assets were $123 million. 6 million shares were issued for private placements. In a total of $31 million for the 9 months and $11.8 million for Q3. And then 7.2 million shares were issued for acquisitions at a total value of $47.8 million year to date. Briefly, acquisitions in Q3. In Q3 we closed High Five, which is now Halo Kuzbar. Retail. We also closed Food Concepts, which is part of an indoor grow in Oregon, in Portland. And also we closed Williams Lumber, which is another grow in Oregon. So those three were closed in Q3. We're still waiting for the closing of the operating dispensaries in LA. That concludes my presentation. So back to Katie.
Thank you, Philip. Before we dive into the question and answers, Kieran will be presenting a corporate shareholder update as context.
Okay. Thanks, Katie. So for those of you who have a screen, the way we sort of view Halo Collective is it has 3 components to it plus our core component. Our core component is our operations in California and in Oregon. To the left of those of you who have a copy of the presentation, we have Triangle, which consists of the land, which we own 50% of, which is Lake County Natural Health, and BarX, which is the operating entity under Triangle. We currently have a 44% equity position, and we have approximately, right now, I would say a loan of, this number should be corrected, about $2 million, and an offtake agreement for flower. Strategically, when we saw the market start to collapse towards the end of, let's say by early Q3, we decided at that point, as the market was in a swoon, to defer growing at Triangle to next year or 2022 season. We just launched our, we haven't launched it yet, but it's been declared effective by the SEC. Our offering at Triangle, which is a Reg A+ offering for up to $75 million in equity at $165 million US pre-money valuation. We hope to be launching that within the next 4 weeks, and we'll press when that is announced. And based on that, I think depending on how much funds come in, We will implement something at Triangle next year because it is our view, if you read our press release, that given the amount of temporary licenses, the headaches with the CEQAs, and the swoon in the market, we'll see what we saw in Oregon a couple of years ago, which is a complete sort of what we call rubber band effect, where in this year, where prices are very much suppressed, next year they'll rise as supply comes out of the market due to both regulatory change and just hardcore Adam Smith economics. In the middle, we have Halo Tech, which are non-280E assets, which we are spinning out through a return of capital to shareholders. This should be completed by Q1 of next year. And this, as we said in previous terms, would create about, in terms today, would create about, I would say, 20 to maybe 20 to 50 cents worth of value in today's terms. And we're looking, and this also allows these assets not to be encumbered by ourselves, which are a 280E taxpayer in the United States. Aconda is really, in many ways, the jewel we have in our crown. Our equity position currently is 68%. It's our view that inevitably we will have to lower our equity position, which is expressed here, in order to effectuate a senior exchange listing, in particular in the United States. Currently, no plant-touching U.S. MSO has had a senior exchange listing in the United States, nor are we eligible, any of us, for these listings. I think that we would not. It's our view that we need to make sure that Aconda is unconsolidated when we go for, if they attempt to do something like this. And right now we're in a high equity position. So when people ask about selling shares of Aconda, we would look to sell down a portion of our shares. But in turn, we have $6.6 million of repayment of loan that we can convert. So our target is to remain, at 49.9%. I've seen a lot of criticism saying, well, why don't you own 100%? But to be quite honest, given the tax status of 280E and the new tax regulations, Aconda would be incredibly burdened by us. From a tax perspective, as we basically pay taxes on gross profit. And on its own, it is, I think, a lot more valuable is our strong view, given one or two recent flotations on U.S. senior exchanges. So it is the strong view of the company and the board that having 49% of a company that potentially could be worth hundreds of millions of dollars is more significant or more important than having a dangling subsidiary of a U.S. MSO having international assets that would be incredibly less valuable under us just due to tax positioning. Okay, so going to this path to cash flow, Katie, you built this slide, and you can explain to people how this works.
Sure. What I will do is I will give the overarching message here, but this is based on the analysis that Philip did. So the idea here is, and you heard Philip speak to it when he was giving his presentation, but there is this idea that The actual loss in terms of net profit this quarter was comprised of two components. Non-cash items, which you see are the first two bars, which have been adjusted here, and the actual cash used in operations was about $6 million. And Philip mentioned that figure in his presentation. And each of these components are items that going forward, we expect them either to simply go away, with regard to Wakanda, and Philip can get more into that, or based on steps that we've taken already or are taking to further reduce expenses. So Philip, do you want to add on to that?
It's the, let me just, 1 second.
Yeah, and just so everyone can see, what you see on the y-axis here is in millions of dollars. And what you're going to see is that if you look at the cash used in operations, which is the 1, 2, 3, 4th bar here, fourth from the left, you're going to see that that's the cash used in operations in Q3. And if you look at each of the subsequent adjustments here, we actually get to cash positive by the time you take into consideration some overhead reductions that were identified both by Philip and our SVP of operations. But anyway, Philip, what do you want to say?
Well, I think the slide is pretty self-explanatory. I think that one thing you could say is that if you look at the total of the 6 to make it easy, is Wakanda explains in total, and that's really it, that is its corporate salaries, G&A, professional, those things add up to $2.4 million. And once Wakanda is deconsolidated, 2.4 of that 6 basically just disappears. Then at our end, to get to the 6, you get Halo itself. That saving is $3.7 million in total, which is the corporate salaries reduction is $1.5 million. The last component of that is actually cash, the largest component. Professional fees, I explained it when I did my presentation, is a reduction of $1.3 million, and that's really to do with a lot of that has to do with M&A, closing costs. Finder fees are typically shares, but they actually disappear out of the equation. And then you have legal of $300,000, and you have consultants of about $46,000. So they go down. So that is a total of $1.3 million. So that makes your $3.7 million for Halo, and you don't actually really have to do anything for it. It's just by not doing acquisitions or deconsolidate Wakanda. We also believe that we went through a real cleanup of the accounts receivable. That those things are now pretty much behind us, and the same with impairments. Although you never know with pricing, that there could still be inventory impairments going forward. But in AR, we're getting close to where we should be. And then also, one of the things is when you look at the gross margin, in there you have your, I call it your contribution margin of each product based on the bills of material, and those prices have come down. That is not entirely reflected yet, and that becomes a positive impact in Q4. So that will help. And then you have in there you have your kind of it's almost like a fixed cost for production overheads. And we had a first go at it, and we found nearly $600,000 in cuts there. So and there's more to be done there. That was just actually in A&M and in East Evans Creek. I think that's just a little bit of color on that chart.
Yes, agreed. Okay, so Kieran, back to you here to discuss our brands.
Okay, so part of what our strategy is obviously to open retail. And the first is what is our Westwood store going to look like when it is opened? We're targeting a soft launch in the next couple of weeks, with a hard launch to follow a few weeks later. So this store is well on its way. It is the closest store to Century City, and it is the closest store to the flats of Beverly Hills. So it's really well positioned. It's in a great location right on Santa Monica, just east of Beverly Glen. And, we're looking forward to this one. And the North Hollywood store will soon follow. The Hollywood store in Franklin Village will soon follow, and then the North Hollywood store would follow after that.
So for all of you that are following along with the webcast or looking at the presentation, I believe that this is this would be slide 6 that we're on, but Kieran, would you like me to flip to the next slide?
Yes. Okay. So we've brought in a CMO, and part of what we've done to reduce costs, which Philip didn't mention, is we've brought in general counsel with Julie Sue, and we brought in a CMO from another MSO, and now we are revamping our Hush line with more vibrant colors. We're adding more SKUs to the Hush line, and we're launching more SKUs aggressively. Our target over the next 6 months is to launch 50 products, either revamped or new, in Oregon and California. And this gives the people who can view it a flavor of what is coming, which is a lot more vibrant and pops off the shelf than we have now. Woodbury Farms, which is really our upper-end brand that sells at higher margins. We're also doing a revamp here, and we plan to launch this aggressively in California in Q1.
Okay, great. Is there that's the last slide here. Is there anything else that you'd like to comment on before we get to Q&A?
No, that's good.
All right, great. Well, again, thank you all for being with us. We had Q&A submitted on our investor channel, so we've consolidated them and allocated them to each of us. So I will be moderating the questions and answers, and Kieran, Philip, and myself will be responding. All right, so this first kind of category is regarding the company in general, strategy, that type of thing. So the first question, and this is for Kieran and for Philip, is what is Halo's business plan for the next year, 3 year, 5 years, et cetera? What's on the horizon, and what are the timelines and current project milestones? So
in the first year, looking forward, in terms of acquisitions and in terms of vision. In terms of vision, we're really focused on California and Oregon, and we believe that the markets in both will recover next year, and it's just a question of getting to next year's harvest. And what we're already seeing is a lot of what I would call blood on the streets, and a lot of overtures from many different players at many different levels to do transactions. We're lining up, as you can tell by our announcements, debt. We're trying to line up more debt to minimize equity impact, but we have to balance that with the fact that a lot of the people who are talking to us, really would like an equity ride. So it's a fine balance. So I'd say in the next year, you're not going to see a lot of action from us outside of our core markets in California and Oregon. In Oregon, we need some more indoor grow, and I think we can expand that at Food Concepts or the Pistol facility. We also could pick up a couple of more distributors with product lines that we could add. There are a couple of players that are over $1 million a month that would give us more share, and that is Oregon. In California, it's really dispensaries and getting our grows, all three. With Triangle, we have 2, which is outdoor and greenhouse, and as well as indoor at UVI. and it's really an implementation game at this point with that. The other thing we're looking at with Hush Rooms and some of the beverages are what we call mainstream distribution. We have a strong partner, and we have their shares on our balance sheet in Elegance. That with Sway is the drink of the Phoenix Suns and also the principal sponsor for the Miss USA pageant, or the principal beverage sponsor. And they have very good distribution. So if we can leverage that distribution and leverage the beverage technology and add some more SKUs, let's say, and some more tech there, I think that we could build a little bit of a business there, and we're going to try that, I would say, in the medium term. In the longer term, saying 5 years out, which is an eternity in cannabis, I think by then there'll be consolidation. And at this point, looking at some of the companies that I thought would be consolidators and their reported results, who knows who the consolidator will be and who will rise. But definitely the company in 3 to 5 years will look radically different than it looks today. Also with federal legalization, it is our view that Oregon is by far the best place for to be in a federally legalized world with interstate commerce, given labor costs, given its terroir, or the land that we're in, and the cannabis we deliver at lower cost. California is still with CEQAs and cultivation taxes and all that good stuff, is a perfect geographical climate for growing marijuana. That being said, it is definitely, has its regulatory challenges that Oregon does not. But, it all started in the Emerald Triangle, and inevitably our view is it'll all end in the Emerald Triangle. And the Emerald Triangle, and we're really at our heart an Emerald Triangle company, where we operate from, is what oranges are to California and to Florida, what tobacco was to the Carolinas, marijuana is to the Emerald Triangle.
Great. Okay, so I think that was a really that was a great answer, and it was holistic. So, Philip, perhaps you can take this next question, which is regarding projections, targets, run rates, and deadlines, essentially with what we potentially were expecting or planning and the results and the variance. So can you comment just on essentially some of the drivers of the differences in actual results?
Well, in terms of the projections, the targets, we're operating in kind of in a difficult market environment. Now, we've had to deal with COVID, which was not expected, and then we have the aftermath of COVID, which resulted in Q3 actually in really difficult markets. Also when I look in our own product mix, there's a lot of let's say volatility of sales in the channels. And that makes it actually difficult to project. I mean, to give you an idea, like we had a 5 million gram trim trade in Q3. Well, will it recur? Will it come again or not? So we have some of the sales are bumpy. Some of it's related to like really difficult markets. And also, I think Halo Tech is an example of that, where we took on a lot, and we came to the conclusion that let's focus on the core business and not get deviated from that core. Now, Halo Tech, like you could argue, is I think it's a really interesting asset, but it's not core. So by selling that off or distributing that to investors, we get far more focus and we get a much better idea of how to move forward in our company. Then deadlines. I think it's related to the fact that we took on a lot, and by actually restricting ourselves, it will be much easier to actually get to the deadlines. I mean, once I come down and Halo Tech are no longer there, we have the core assets really in Oregon and California. I think that projections, targets, deadlines will all become easier.
So I think another way of looking at this is, the term some people have said is your projections are wildly off. And they are wildly off because Oregon and California have wildly crashed. I mean, a 17% constriction from April to September. And if we look from May to October, it's probably north of 25% is, in most businesses would destroy most companies in the business. We went from what we call the COVID bump to now what we're calling the COVID slump. And the COVID slump was not expected by us in hindsight. And to add insult to injury, both Oregon and California geared up thinking that the growth would be continual. And in California, if you look at some of the articles, people think that it could be up to 20 times oversupplied. All this being said, we're a really scrappy group of people. We've lived through this 3 seasons ago in Oregon that decimated the Oregon market, where we actually had negative gross profit margins. And what happens is those who can survive or weather the storm will have more success on the other end. And that's a really important concept, and a lot of people don't get it. And that is, whatever is done is known as sunk cost. And so when we look at things, we cannot look, with a lens on the past, but we have to look at what is going to happen in the future.
Agreed. No, both of you said it very well, and there are just so many companies that are in the same markets where we are that are going through the exact same thing, if not at a larger scale. So well said, both Kieran and Philip. All right, this next question that we have was regarding M&A and whether we're looking at specific companies to merge with. And Kieran had mentioned this earlier on the call, but we've been studying and following the consolidation in our industry, both nationally and regionally. And we are not currently in any one merger discussion with any one company, but get approached all the time because I think every operator understands that the market conditions are really starting to facilitate a need to not necessarily go big or go home, but get scale to increase their efficiency to continue operating. So we have been approached by private and public companies to sort of enter into these strategic discussions. But with that being said, we believe that we have to stay focused and execute on our seed to sale strategy for any of these discussions to go anywhere, favorably speaking. And what I mean by that is open our retail in California and optimize our retail footprint. And then to what Kieran was saying earlier, look at executing on the grows that we are planning in Oregon and California. So we think that by remaining focused on that strategy of seed to sale in both markets, it'll just put us in an even more favorable light and continue to attract the interest of companies that see potential to scale their business through consolidation potentially, but that this is further down the road. Okay, great. Kieran, this question is for you specifically, and it's regarding what multi-state operator do you admire or think is doing a sort of leading job in the industry today?
In my mind, it's definitely Cura, even though, let's say right now we're ahead of them in Oregon. They've executed quite well. Their stock is performed relatively well. It's only down, I believe, 50 or 60% relative to the index, which is down 70 to 80%. And, they're looking also abroad. They're doing it differently than us, and I question how they're, consolidating a German or a European entity and actually burdening it while we're actually trying to realize value with it. But as a company, I definitely admire them. I admire what they've done, and I admire how they've operated in so many markets so well. The other thing, which is interesting to point out, a lot of people have asked us, thinking about our international assets, a lot of people have asked us, well, do we plan to liquidate Aconda? And all I have to say is that as an affiliate under U.S. reporting guidelines, it's not possible to liquidate. And also, any underwriters would definitely lock us up for a considerable period of time. So the only liquidations of Aconda we're doing is those pieces that we have to liquidate to remain under 50%, and we're currently around 65%, I believe. But that being said, then we have our convertible debt that will, that'll keep us sort of anti-diluted as we convert it over time, as Aconda continues to raise money at higher and higher valuations.
Okay, all right. Philip, one question before we get into some other topics here are regarding inventory levels, rising inventory levels and turnover. So, and then specifically, how does increasing grows in Oregon make sense if the sales aren't sort of commensurate, with it and continue inventory levels? I think just the dynamics around that would be helpful for you to explain.
Well, the inventory is in particular related to flour, like to the raw materials, which we actually sell as some extent also as a finished product. Looking at kind of days of inventory, because the company actually grew through acquisitions such as Winberry, the days of inventory haven't really increased that much versus what we had before. So although you see inventories increasing, it's in line with what's happening in our business. Having said that, we think that, and that's what we've also told sales and operations, like we just had a harvest, and basically we have working capital of about 14 million. So now we say, okay, sell that harvest. So basically get the inventory down. So we're working on that. Yes, but the numbers are not, although you see it increasing, they are not out of whack with what we've seen before.
Mm-hmm.
The other thing is that we want to use our balance sheet, and I'm going to use a pretty aggressive term, as a weapon. And we are going to pound our competitors in Oregon. And we are going to go after the open to buy dollars in dispensaries, which are shrinking massively, some dispensaries by 50%. We're going to go after those dollars and be the early ones in at the most aggressive pricing, leveraging our scale and leveraging our inventory. So whatever we can sell, we're going to sell, and we're going to sell it aggressively. We've been through this before, and prices are falling like a knife, and we're going to use that inventory very aggressively.
That should help with the turnover, undoubtedly.
Definitely. And what it will do is it will accelerate, let's call it, the rubber band effect in these markets. And I wish 3 years ago we were more aggressive when Oregon collapsed. And this is something every market's gone through. Ryan's experienced it in Washington, Colorado's experienced it. But I don't think anyone has ever seen it on the scale of California, which is the largest cannabis market on the planet currently.
True. Okay, so we have a question here that's submitted just in general about the company's marketing and branding and the fact that we've started to focus on it more, and basically our shareholders and folks that follow our company can tell that. So I think, Kieran touched on this when he was walking everyone through the corporate update with some of the brands and retail and product positioning. But essentially, we have been consulting with a very seasoned professional that not understands marketing and branding very well, but understands cannabis very well. And with this expertise, we have developed a concentrated marketing plan to support the launch of new products, and as well as highlight the Bodega branded retail stores that will also have a product line. So with all of these, and I think the other thing that I would comment on there is that what we've done is differentiate and really tap into the true voice of Hush and Winberry, and with those products, just geared them more to be consumer-centric in terms of the segment of the market that we would like them to reach and that we know they do reach. So with those sort of insights in mind, we've been updating the branding, and we are in the process of launching new packaging and many new products in Oregon and California throughout Q4 and into Q1 of next year. The wholesale brand strategy as well includes 3 unique lines to support the consumer interest: Hush for the price value conscious, Winberry for the canna curious, and a third brand that is actually in the works for a terpene-centric customer.
Yeah, our marketing is headed by, when we announce the person, someone that understands this business very, very well, has founded, has been a founder of a very, very successful MSO, and we've given him carte blanche to revamp everything and get us more brand centric, and I'm happy with the results, and I think we'll be seeing those results starting to manifest itself early next year.
So the next question is regarding some of the subsidiaries, and this one in particular, Halo Tech. Philip, people are wondering about just a general update on Halo Tech, potential software demos, what is in the software suite, and how the applications will be integrated.
Yeah, so over late 2019 and in 2020, we acquired 6 companies, varying from software to hardware, but all related, like auxiliary to the cannabis industry, but not plant touching. And as I said before, for us it became too much to develop it. We decided to spin it off and to have its own management and distribute it to investors. So what happens is basically Halo Collective purchases gives these assets to investors by repurchasing shares in Halo and then issuing shares Halo Tech. Halo Tech, that's 12%. So basically, Halo right now will be buying back 12.2% of its share count, and then in exchange for that, issue shares in Halo Tech. Then what we're doing is we have a new management, which is from outside of our own company, that is going to manage Halo Tech. They actually also have a technology company, and we're looking to bring those 2 companies together. And then once we have distributed kind of our side, our part of it, we are then looking to list it on one of the Canadian exchanges, so that we actually then, for investors, create a liquidity event, so you're not kind of stuck with something that you may not want. So there will be liquidity. And we do this at book value. So we acquired all these assets, and then including finder's fees, closing costs, anything to do with these assets is going to be put into Halo Tech, which means that for, let's say, the current investor base, there is no negative impact from the spin-off of Halo Tech because it's happening at book value. So where you may say that we have been doing dilutive acquisitions, now this is the one where we unwind from, and it's going to be non-dilutive. In fact, it's the opposite, so there will be no dilution. And this is, we're working on this right now. We have a draft prospectus. We're looking at the merger document with the other company, we're progressing, and the idea is that all this will happen in Q1 2022.
That's great. No, that's very helpful, and I think it clarifies exactly what we're doing there in the timeline.
There's one additional comment here, and that is that questions about does it actually exist? I can tell you that when we had our audit last year, our audit firm wanted to see all these applications work. So I can tell you that they're all there, and they all work. Otherwise, the audit firm would not have signed off on them, and they're all there.
Good. Great. All right, so the last couple of questions, there's one on Aconda, but Kieran, you answered it earlier, just regarding our plans for Aconda. So regarding California, Kieran, there was a question regarding Ukiah, UBI, and essentially what is the plan with that space and the progress that we've made and what role we see it essentially playing over the next year.
So one thing we sort of learned, like with the dispensaries, bringing in Ford and a team, is that, in theory, you can open 5 dispensaries concurrently, but practically you have to sequence 3 over a 4 to 5 month period, given the size of our company. Same thing with UVI, where we had to sort of focus our efforts on Pistol, and once that gets rolling in Q1, we can get UVI rolling. That being said, we have a great group in Burke Construction Management. It's done a lot of work for Cookies and others, who has done a full design of the facility. We know what the costs are. We're ready to pull the trigger, but we want to first get Pistol done, get that dialed in, and then we'll move on to Ukiah. Also, as some of you may or may not be aware, the indoor flower market has not suffered as much as the outdoor or greenhouse, but it has suffered. And so there, you're not going to see as strong of a rubber band effect, but you have not seen as strong of a drop.
Right. Agreed. Fully agree with that. I think a natural sort of follow-up question is just, again, commenting on the supply and demand in California, the oversupply, and also then what is our thought on whether Triangle makes sense? So, Kieran, did you want to comment on that?
Yeah, Triangle definitely didn't make sense this year, but in some fashion, it will make sense next year. Will it be all 65 acres? I don't know. I mean, that will be literally a game time decision. And game time will start probably middle of next month, right, as we have to order massive amounts of soil and other stuff.
Agreed.
And we're going to have to look at that hard. We're going to do something for sure. It's a question of how much we're going to do relative to, buy versus grow. And right now in California, you can buy cheaper than you can grow. But that will change as we think next year, and we've outlined in our press release with very definitive detail how we think that will change.
Yes, I agree with that. That update goes into a lot of depth surrounding the progress that we've made to date and the Reg A that we're about to kick off to raise up to $75 million for this project. And again, it's all about thinking about the proper use of that capital, the timing of it. And so that Reg A will be kicking off. But again, we've spent our time this year ensuring that all of our licensing is in place with the state. And preparing some of the bulk contracts and that type of thing. So we're in a good spot, and we're following the industry closely to make sure that we make a wise decision about how much capacity to invest in next year. So we basically run out of time, but I know that there were a couple questions regarding the dispensaries, and I'm happy to give an update on those. The first question was regarding the opening dates. So for the Westwood location and the Franklin location, those two are in the process of being construction process currently. So they both, had permitted plans and are in the process of construction, and Westwood is nearly finished. So essentially, the only thing holding up the store openings will be securing all of the cannabis licensing, which dealing with local and state governments, they have a lot of applicants that are in the queue, and it's not so much an if, it's a when. So we are, pushing forward on all fronts, but still expect to open Westwood in December, Franklin in January. And then North Hollywood, we have set a target open date for June 2022. And we will continue to keep you apprised. I think we did a retail update fairly recently once John Ford was fully on board, and we will continue to update everyone on the progress. The second question regarding the retail was just about how many dispensary stores we're thinking of, and we've mentioned, up to 10 stores in the state of California. And what I would say to this is we absolutely believe there's benefit in having some type of scale in terms of a retail footprint, and 10 is an internal target that we have to identify opportunities that are retail opportunities in California. But that in and of itself is easier said than done, in the sense that we're looking for a dispensary that isn't just in process, but one that is on the brink of opening or already open, one that, maybe isn't the largest dispensary in the area, but one that we think with our exceptional retail management team we can add value to. And then, obviously looking through the liabilities and making sure there aren't any liabilities we can't handle when we take on, whether that's, backed up taxes or whatever liabilities you might find when you're doing due diligence. So we have a very rigorous process to scrutinize any potential targets, and the 10 dispensaries, would be an additional 7 by the time we open the first 3. That is an internal target, and we constantly look at retail deals. But again, this is also a balance too with making sure that we're identifying good opportunities and not biting off more than we can chew as we really focus on executing the store openings. So that is what I would say, and I think that what we potentially see is once the stores are open, our focus will shift more not to make, to adding on additional stores that allow us some scale in California. So that really covers it. That really covers most of the questions that were submitted. Obviously we encourage you all to continue interacting with us on all of our social media channels, and we answer whatever questions we can, as quickly as we can. And I didn't know if Kieran or Philip, you had additional comments before we wrap up here.
No, all good. I mean, Q4 is a transitory quarter. And Q1 is definitely, we definitely are trying to target that, as as you could see by the overheads, provided that market conditions don't deteriorate further. We think that that quarter we're going to show significant progress. We're going to show some progress in Q4, but significant progress will be realized in Q1. In terms of guidance, we've withdrawn guidance, but we plan to give guidance at our next, immediately prior or prior to our next conference call, which will be on or before April 15th, 2022.
All right. So Josh, do you want to wrap things up here?
Certainly. Thank you very much for participating in today's call. This does conclude the conference, and you may now disconnect.